wanted to take just a couple minutes today to talk about what we've been seeing happening in the economy. On Black Friday, which is normally supposed to be a nice quiet day, typically a positive day for the markets, we learned about a new variant now that they've named Omicron. And I'm not going to go into all of that. Obviously, it's too early. I'm not a scientist. What I want to talk about more is the impact it's having on the stock market, regardless of how this turns out. Now, what people are forgetting is the economy was already slowing. Our economic model in October gave us a signal that the growth rate is slowed enough that we're in what's called a transition mode. And remember, I've talked about for quite a while that, look, we're going to have some tough comparisons. We're comparing progress this year economically to last year when we already had 2 stimulus checks and then a third one on the way in early 2021. All of that's kind of run through the economy. Between the Federal Reserve and Congress, we dumped almost 50% of GDP into the economy. And that also has caused inflation. Hopefully you had a chance to check out our last economic update. If not, we'll have that linked below. But inflation was really a major problem because we put so much money into circulation. And that's likely going to ease, as I mentioned in our economic update, but not until that also hurts the economy. Because remember, one of the things that I said in my update was inflation is actually deflationary because people just stopped spending money. And that's just how economics work. We've also learned recently that the Federal Reserve is planning on accelerating their reduction of stimulus. So not only will we not have stimulus checks hitting the economy, we're going to have the Federal Reserve now saying because of inflation, they're going to have to pull back much quicker. Now this is obviously it's an experimental time with the economy, and the Fed has dumped so much money into the market. They pulled out all the stops, and now they're trying to figure out what's going on. Unemployment is at close to all-time lows at the same time that the economy is just not picking up. People aren't going back to work for whatever reason. Again, we talked about that in our economic update. This is all happening at the same time that stocks are at record high valuations. Even with the strong earnings, a lot of people said, okay, well, the stocks are just pricing in a strong recovery. Even as we've started to get those earnings, and third quarter earnings were definitely spectacular, things like price to sales ratios, price to earnings ratios are still very, very high, which is fine if you're going to expect future strong growth. But we're simply not seeing that happening. And, as I said, inflation's already becoming a problem. It's slowing things down. So we have that. And one thing we've been watching, and I've talked a lot about this with our advisors, is high yield bonds were holding up. A lot of people might know those as junk bonds. High yield bonds are the best indicator of what the overall investment markets think about the economy. And they'd been holding up through all this noise all throughout 2021. Well, on Monday, Tuesday, and Wednesday of Thanksgiving week, all of our sell signals triggered in the high yield bond market. For the first time, we were selling things that we bought back in April and September 2020. So we had held on for a really long time as things projected higher. This is kind of a warning sign, and it's something that I pay close attention to. We've been managing high yield bonds with this system for 30 years, and it's one of the best indicators of, hey, when this system triggers, we want to take a step back. And now this is important for both our clients and advisors to understand, is we have 3 different management styles. We have tactical, dynamic, and then strategic models. The tactical are watched every single day. It doesn't mean we trade every day. And we were literally throughout 2021, within a couple of days of getting a sell signal, those finally triggered. That's designed for our lowest risk strategies because it gets you out quicker. And then we'll ask questions later. Maybe things recover. December is typically a really strong month for the market. And I hope it does. But all this volatility is telling our lowest risk systems, hey, let's sit it out and wait for better opportunities. At the same time, our dynamic systems, which monitor the economy, had already pulled back in October because the economy is slowing down. And they're getting really close to going to what we call a bearish mode, which means the growth rate's actually declining enough that it's likely to cause future problems for the stock market. And we'll know here in the next couple of days. So that's also putting defense on the field, as maybe possibly more defense on the field. The strategic models are designed for your long-term investments, designed to keep you invested. but then fit everything into your personality, your financial plan, and everything else. So this is critical. We've been sending throughout the fourth quarter these emails saying, hey, it's time to update your suitability, take our risk questionnaire. If you haven't done so, we'd encourage you to do that, because this allows us to then take a look personally at your account. So one of the advisors and portfolio managers here at SEM will look at your account and say, does your current allocation match with what's happening with your personality and your financial plan? And that's what it's designed to do. So if you're wondering, hey, am I in the right mixture? Just take that questionnaire and we'll let you know. Hopefully this is the last update you hear from me. You tend to only hear from me when things start to get a little bit dicey. And I've received enough phone calls and emails this week about concerns on what's happening with the economy that I thought we'd do this quick update. If not, I hope everybody has a Merry Christmas. I hope you spend some time with your friends and family. Let SEM worry about the markets. That's our job. If the market's open, we'll be watching your money so that you can get and just go throughout your life and enjoy the things that you like to do.